Hey, in this video, we'll be going over the normal closing costs for a conventional loan. So let's get to it. Hey, welcome to another episode of Good Things Come to Those Who Real Estate. My name is Paul. I'm a real estate professional in the Houston area, and the purpose of the show and channel is to help families move by making the home buying and selling process a little bit more simple, a little more smooth. So we want to be here to give you some tips and tricks to help that out. One of the biggest questions I get all the time is, hey Paul, I want to buy this house, but hey, what are my closing costs going to be? And I have this great little calculator I can do, kind of give a ballpark number. But the number one thing I say is, hey, call your lender and get a more accurate number. So I thought today it'd be great to actually have a lender kind of go through some of the expenses that add up to the closing cost. So today I have Mike Boucher here, awesome guy. We refer him clients all the time, does great work with them. So Mike, thanks so much for being here today.
No, Paul, thanks for having me out. I'm really enthused to be here.
Awesome. Hey, tell us a little about yourself, and then also kind of explain what a loan originator or a lender does.
Absolutely, yeah. So my name is Mike Boucher. I'm a native Houstonian, and I've been in the mortgage business for about 6 years now. So as a mortgage banker or a loan originator or a loan officer is all kind of different terms. Basically, what our goal is to shepherd people through the financing portion of the home buying process.
Okay, awesome.
Yep.
And then how long you been in the business?
6 years.
6 years.
Yeah.
Wow, that's awesome. And you were former life. You were a
Well, I was a Marine
there
at
you
one
go.
point.
There you go. Yeah, I want to get that out there.
Yeah.
So
Comes up,
I think it's
yeah.
kind of important.
Yeah.
Yeah. Awesome. And so yeah, I want to kind of dive in. So when a buyer tells me, hey, what are my closing costs? I mean, what should I tell them, or how would you coach them as far as going through?
Yeah, no, that's a great question, Paul, and it's not one that's easily answered, right? When we talk about buying a home, there's so many variables, and they can all kind of trigger different differences in our numbers. And kind of in the beginning stages, we're operating off a lot of assumptions. So generally what I like to do is when I have a conversation with a borrower is I like to actually back that conversation out a little bit and kind of look at the big picture, and let's talk about cash to close. Okay, when the day to close comes around, we're going to bring a cashier's check or set up a wire for funds, and it's going to be a bunch of money, right? And so in that cash to close, we're going to basically have 3 buckets of money. Okay, the first bucket of money everyone's pretty familiar with. It's your down payment. Okay, most loan programs require that there's some sort of down payment. Okay, the second bucket of money is kind of what we would call prepaid items or escrow setup. This is the bucket of money where we get the most questions on. And then the third bucket of money would be our closing costs, which is what we're talking about here today. So closing costs basically is any monies that the lender and the title company are going to charge to get the deal done. That's effectively what closing costs are.
Okay. So with let's go through those 3 buckets, because that's a great way of looking at it.
Sure.
So the down payment with conventional loan, we've been at 5% as a minimum down payment, but now they changed that a little bit.
There are programs that allow conventional buyers to put as little as 3% down.
3%.
Yeah. Now you'd have to check, with an originator, with a mortgage banker to see if you qualify for those. Typically, they're looking for first-time home buyer, and there may or may not be income limits in your area. So
Okay, income limits. Now, is it more expensive at 3% as far as the cost and everything, or is it about the same?
So in the lending world, typically what happens is it's all about risk, right?
Okay.
Different layers of risk. And so generally speaking, when we put less money down, there's greater risk for the lender. So you may see things like your interest rate might not be as low as if you were to put 10 or 15% down. Your mortgage insurance may or may not be higher or lower depending on the loan program or how much you choose to put down.
Okay.
Yeah.
Okay, so a few things that are affected by that.
Absolutely.
Okay, cool. So that's the down payment bucket. Then you said prepaids.
Absolutely.
What is entailed in that?
Yeah, so it's kind of like our prepaid items, and if you're putting less than 20% down, you're going to have to escrow your taxes and insurance. Okay. So we'll kind of unpack that here in a minute. Basically, prepaid items, the big ones that I can think of off the top of my head are going to be your prepaid interest and your homeowner's insurance premium for the first year. Okay. I'm fairly certain that every lender out there is going to require the property to be insured for 1 year from the day that you close moving forward. Okay. So we're going to take 1 year insurance, we're going to pay that. Okay. Prepaid interest, it sounds kind of fancy. A simple way to think of it is like this. Rent is paid up front. If I'm going to rent an apartment from you January 1, I pay you January for that entire month. Okay. A mortgage is slightly different. I can't charge you interest for days that we haven't accrued yet.
Okay.
So let's say I'm going to close. Let's say we're going to close on this house. What's today, the 19th of December? So we're going to close on the 19th of December. I will go ahead and pay the interest from the 19th of December to the 1st of January.
Mm-hmm.
But when January 1 rolls around, there's no payment to be made because I've already paid all the interest that I owed.
Okay.
Okay. Our first payment is going to be February 1. Okay. And that will include the interest from January. Okay. So that prepaid interest is just that money, the interest that we're paying from closing date to the next month.
Okay, that makes sense.
Yeah.
And that was always kind of as a big question. Hey, when's my first payment? You know, so a lot of buyers will pay for basically that first month and a half, maybe 2 months, and so that first payment's usually not really due until February 1. Is that about right?
If we closed in December,
Mhm.
then we would make our first payment February 1.
Okay, awesome.
Yeah.
Okay, so we got prepaid interest and insurance is kind of the prepaid bucket there.
Correct. And then typically what happens, the trend that I see usually, whether someone puts 20% down or not, is they escrow their taxes and insurance.
Okay.
And escrow, you know, that word gets thrown around a lot in our business. And for realtors, it means one thing, right? It means our deal's in escrow.
Yeah.
And then for lenders, it's another thing. Basically, it's a fancy word in the lending world for a piggy bank.
Okay.
So what happens is we decide that we're going to pay our taxes and insurance each month so that when the end of the year, we don't have to think about it. So what happens is when we go to closing, we're going to take 3 months of taxes and 3 months of insurance and put it in that piggy bank ahead of time.
Okay.
Okay. So you can see, obviously, depending on the tax and insurance of a home, that can affect our cash to close quite a bit.
Okay.
Right. And then basically what happens, you put those 3 months into the piggy bank. Each month you're paying a little bit into that piggy bank. So at the end of the year when the taxes come due, the lender is the one that's administering that payment, and you don't have to go into your checkbook and cut a check for the property taxes.
Okay. Now, taxes, is that usually 3 months, tax and insurance, or is that sometimes they do a year, depending on the loan?
No, another good question. we're going to get in there today. Okay, so cool. So on taxes, on the settlement statement, in fact, I have one here. I can show you. It's kind of interesting. So again, let's say that we're going to close December 19th. We're going to close today. The way that your settlement statement will read is it's going to actually show like 12, 15 months into escrow.
Okay.
Right? And people are like, why am I paying 15 months of taxes? Well, what happens is then the seller turns around and gives you a credit for the amount of time that they occupied the property for the year.
Okay.
Okay. So then you'll see later down in the settlement statement, the seller is giving me a credit for the taxes from January 1/18 to December 19, 2018.
Okay.
So we effectively, pretty much in most instances, net 3 months into our escrow account.
Okay.
Now, towards the end of the year, typically what happens is those tax bills are due and payable. The seller will pay those taxes, but we still have to put our 3 months into escrow.
Okay. Yeah, so it's always confusing looking at a closing document because then they'll charge, the buyer here and then they, credit here, and it's like, just tell me what to bring. And I think that's most homeowners, like, just tell me what check to write and I will.
Right.
So it's good to I want to go over some of the big ones here, and this is the prepaid bucket is helpful.
Yeah.
And moving into the closing bucket, it's kind of a different relationship because you're working with the title company,
Mhm.
and then insurance and the county for taxes and all these different
Right.
things come together. Tell us a little bit about the closing bucket.
Yeah, so closing costs. So, we talked a little bit about how our closing costs are the monies that the lender and the title company will charge effectively to get the deal done.
Okay.
Okay. And I would say in the Houston market, typically what we see is lenders are charging anywhere from $1,200 to $1,800 ish. Okay, and let's call it origination charges. Now it might appear as something else on your estimates. It might show as a underwriting fee or a processing fee or whatever we want to call it, but effectively these are origination charges, okay? And it's not where the lender's making their money, quite honestly.
Okay.
What they're doing is they're covering the legit cost, administrative costs to get the loan done. Okay. But you will see that vary. That's why it's hard to say, oh, closing costs for this price home is X. Like there's no formula because these numbers are going to vary depending on the lender that you choose.
Oh, so, and this is something that throws me off because some lenders will have $500 or $600 here or there, and then just kind of the fees keep adding up.
Correct.
And some lenders will just have 1 or 2 lines of charges, and that's it.
Correct.
And so it's hard to compare apples to apples, but this is pretty standard in the industry.
Yeah, I would anticipate that for most folks in the Houston market shopping around, $1,200 to $1,800 for a lender's origination charges.
Okay. What's as far as that is that dependent on price? I mean, at a $500,000 loan, at a $400,000 loan up to jumbo right there, are you looking at the same rate or versus $100,000? Is it still about $1,200 to $1,800?
Typically, it should be.
Okay.
Yeah, the driver for that number should not be the price point of the home.
Okay.
Typically, what I see, with my friendly competitors and banks that I've worked with, it's been kind of that's flat regardless of the loan amount or purchase price or any of that. I mean, that's just their cost that they've figured out on the back end, kind of how much money do we need to make sure that all of our expenses are covered getting the loan done.
Okay.
Okay.
Now I want to throw this out there. You, small, nimble lender, very personal, great service, for fees versus maybe a big bank.
Mm-hmm.
Comparable, a little bit higher, lower, and hard to tell.
Yeah, I'll speak very frankly on this. So typically what we see is when we look at the mortgage market as a whole, okay, about 40% of mortgages are originated by the big banks, the ones that start with a W or a B or a C. Okay. And 50% of that space is done by kind of independent mortgage companies like myself. Okay. And I think what myself and my peers would see is that a lot of times there might be a rate incentive to use a larger lender, and that may be due to the fact that, quite frankly, they have people walking into their branches every day asking for a mortgage, so their cost is lower to kind of lead generate, right, and kind of get people in the door. Mm-hmm. And that 40%, that's a lot of volume for those few players, right? They're doing a lot of volume, even though it's not the biggest market share. They're still doing a lot of volume, so I think that ultimately helps their lower rates. The fees, I think, are generally going to be pretty consistent.
Okay. The fees still the same, but just the rates.
Correct.
Okay.
Correct.
All right, that's good to know. Any other things in the closing bucket we need to go over?
Well, you would have the title side, okay, and that's why initially, it's always best to kind of plan conservatively, right? If we're just kind of getting pre-approved and we're out shopping for homes, we don't yet know who the title company is going to be. So what most companies will have in place is kind of some fees that we know are a little bit too high, but it's better to for our mutual client to let them know, hey, closing costs may be up to $15,000, but at the end of the day, the whole package, it's $14,000. I think that's a better scenario for most people than saying, hey, yeah, we're going to be about $14,000 at the end of the day, and then that number comes in and it's really $15,000. Generally, they're not pleased
too happy
when that happens, right?
Yeah.
So the effort on the front end is always to kind of plan conservatively, not necessarily pad anything, but make sure that we've accounted for any possible, we're kind of at the top end of those numbers.
Okay. And 15,000 could be like, driving people from out of state crazy. You're like, well, 15,000 to close, but then you're working in the taxes, which is a big portion of that. Yeah. And that's separate from the down payment as well.
It is.
So
it is
15,000 to close, and then plus whatever 5, 10, 20, 50%, whatever it is, down payment it is on top of that.
That's exactly right. And so, I would say it's kind of dicey to kind of put a number on closing costs, just because I said there's so many variables, right? But I would say in Houston, you could probably plan on about $3,000 of closing costs, like true closing costs.
Okay.
About $1,500 for the lender, about $1,500 for title. Typically, I think and that would be a pretty conservative estimate, I would say.
Okay, awesome. And Mike, do you have like just a simple calculator that people can go to check it out? Someone just wants to kind of do a rough estimate or just contact you, what will be the best thing? I
would say, I would definitely get in touch with a local lender, someone who's familiar with the market, someone who's vested in the relationship with your realtor, right? I mean, a lot of times this is why this works, and a lot of times we see transactions with larger banks kind of not go so smoothly. Mm-hmm. They don't know Paul, and they don't know their client, and it's just kind of, we got to get this thing done, but it'll work itself out eventually.
Yeah.
Whereas, when you and I work together, we're not going to wear an egg on each other's face, right? We want to make sure that we have the best possible outcome so that we can continue to drive referral-based business. And so I would recommend, absolutely. Early on, I would stay away from online calculators. I would get in touch with a local mortgage professional, someone with a proven track record, and I would just, get with them and start talking about what your goals are, how long you plan to be in the home, how much do you want to put down? Do you have money for moving expenses outside of what you're showing in your accounts? Or, and just kind of make sure that everyone's really on the same page, that there's no surprises at the end.
Okay.
Yeah,
that makes sense. I mean, this is kind of a big purchase, so you want to be able to understand that, not just some distant bank that you don't have a relationship with.
Absolutely.
So, and I'm with you, and that's why I always say, hey, if you're going to get approval from a big bank, get one from our preferred lenders, like Mike, just because you have that relationship. I can call them up. Hey, let's work this through closing, department or underwriting a little bit quicker. Whereas if you're going to big bank, it's like, well, we've got a 48 hour for closing, we've got 48 hour for underwriting. They're just not as nimble and not as personal as well. So that's why I always recommend working with a great lender like yourself. Mm-hmm. Awesome, this is great stuff. Mike, let's go through. We got an example. Closing disclosure here.
Yep.
Kind of go through a couple numbers.
Sure.
And then obviously this is based on so many different things: interest rate, purchase price, title fees. I mean, there's so much right here.
Yeah.
But I wanted to kind of give some specific numbers, just so people that want to see some numbers and say, okay, this makes sense to me. And so we'll have an example here, and then obviously if you want to get some more detailed information, contact Mike, and he kind of works something up for you. But yeah, let's go through this purchase price of what are we here at? So 370.
Yeah, 373 is the purchase price, and so the good thing about looking at this closing disclosure is that these are standardized documents. Okay, per the Fed, everyone's going to use a closing disclosure towards the end of the transaction to outline the monies that are being brought to the table. Okay, so this would be applicable for any price point as far as where we find the information. Okay. So this first box that we're looking at kind of breaks down our loan terms. So it's going to have the loan amount, the interest rate, and your monthly principal and interest payment. Okay, that will always be found in the same spot.
And that's not your payment, that's just principal and interest.
That's just principal and interest.
Okay.
In this particular instance, this borrower put less than 20% down, so they had to escrow. And if we go to that next box, it's going to tell us our projected payments with the escrow. Okay, and you can see that with tax and insurance, it's almost another $1,000 in this instance.
Yeah, that's good. Mm-hmm.
So, yes.
Okay, and let's dive into some closing costs here. I see at this one we have it where our closing costs are up front, but let's kind of go through some of the closing costs in detail here.
Yeah, so this first box that we're looking at is what we would call our origination charges. Now, in this particular instance, this borrower, I remember this borrower well. He was a great guy. He was an engineer. He was very specific. Mm-hmm. And we did a bunch of analysis as far as the payout of, hey, do I take the par rate today, or do I buy my rate down a little bit and try to save some money in the back end? So we went through a lot of analysis, and we ended up...
Could you go over that?
Sure.
Buying rate down, because I don't think a lot of people know about that.
Yeah, and I didn't know if you wanted to get in and kind of unpack that today
just
or not.
Real quick, yeah.
Okay, cool. So basically, generally speaking, there is going to be a par rate today that you qualify for based on the merits of your loan file, credit score, money down, et cetera, et cetera, et cetera. About 17 different variables that go into the algorithm that price your interest rate. Okay, so your option, you've got really three options. You could take the par rate that you qualify at today. Let's say you're short on cash and you need some to help with the transaction. You could elect to take a higher rate and get a credit back from the lender at the day of closing. Or you could say, you know what, I'm going to put some more money into the deal in closing costs, in what we call discount points, and that will actually reduce your interest rate. Okay, so those are your three options effectively.
So he paid half a point here.
So that would be 0.5% of his loan amount he paid up front. Okay, it worked out to about $16.65, and that lowered his interest rate by some amount. I don't remember where he was at par versus this particular rate. I don't know what that difference was now, but yeah, that's what he did.
So when you pay a point, or I guess half a point, it's not dropping it half a percentage point.
So there wouldn't
some
be
calculation.
Ooh, correct. So there's
Okay.
not going to be like a direct correlation, that a rule of thumb saying, hey, if we buy 1 discount point or 1% of our loan amount up front, that's going to translate to a reduction of X amount in rate. It doesn't necessarily work that way, because the pricing for interest rate is what's changing with the markets throughout day to day.
Okay.
Okay, so those numbers change even hourly. Okay.
Okay. So we got a processing fee and underwriting fees. Is this part of the loan origination cost?
That's exactly what that is.
Okay.
Yep.
Okay. And that works out in 1,200 to 1,800 right there.
Yeah, I want to say we're about 1169, and then we have a appraisal fee of $520.
Okay. So they just worked that appraisal fee in there, which is, you go on the next one, ones that was not shop for, appraisal fee,
Yep.
attorney to review the documents, which, would that be your company or would that be the title company?
That would be, so typically what will happen is your lender has a has an attorney that works on their behalf. And what these attorneys do is they're preparing the closing packages, the warranty deeds and things that need to be signed at closing.
Okay.
And so we pay them to prepare that package.
Okay.
Okay, it's nominal. I mean, it's $175, but it is listed there.
Okay. That just gets passed on.
Mhm.
Credit report and flood cert, so there's all just low costs that go in here. And then other ones here, looks like we've got some survey and then a bunch of title fees.
That's exactly right.
There's a lot right here.
It is a lot, and so these are the monies that the title companies charging to get the deal done.
Okay.
And also different things that the lender's requiring from the title company to be able to close on a loan. You'll see a number of different what we call endorsements. And what those endorsements are is they're guaranteeing, they're basically additions to the title policy. Okay. And those get passed on to the consumer as well.
Okay. Okay. And then I see the guy in here, the title insurance. So a lot of times in Texas, buyers will negotiate for the seller to pay the buyer's title policy, and that's for a title policy to protect the ownership rights, so that some random guy like Uncle Joe said, hey, I actually own part of that property. They're going to protect you as long as you own that property before you sell it. So title insurance is really important, and it's great because a lot of times you can have the seller pay for that, and so it'll be debited here, but then credited somewhere else, and all that crazy stuff. So it usually works itself out on the seller's the settlement statement here. But yeah, it looks like just a bunch of random fees that I never understand. I usually see the escrow fee, which is important, but I tend to see title companies either have like an escrow fees like $450, or they have like a lower amount, and then just kind of the same thing like some other lenders will do, just a bunch of small low charges, kind of get to that same point, $400 to $500.
Yeah, I mean, I would say quite honestly, this particular title company that closed this transaction, that escrow fee is lower. I mean, typically, I tell people that number is going to be anywhere from $350 to $500.
Okay.
For them to have someone there to close the deal, notarize everything, et cetera, et cetera. These folks were only $200.
Okay.
Yeah.
Great. And then so now we're going to the other costs. We've got recording fees. I guess that's another, pass it on, get recorded with the county. There's kind of costs
exactly right.
passed on.
That's exactly right.
And then the prepaids bucket here we talked about, homeowners insurance, prepaid interest, and then taxes. So that's that middle bucket we talked about.
That's exactly right. Yeah, the first item that you're seeing here is their 1 year of insurance that they're paying ahead of time. They are paying their prepaid interest, and you'll see it's from the closing date to the next month, so that's 8/16 to 9/1. And then the box right below is that initial deposit into our piggy bank, or our escrow that we talked about. So what we'll see is 3 months for the insurance. This is actually showing 10 months for the taxes, but again, later on there's going to be a credit from the seller that will effectively reduce this number to 3 months net into their escrow account.
Okay, a little accounting wizardry.
Right.
Okay, yeah, because that $8,500 tax bill can definitely kind of hit you in the face there.
Absolutely.
Okay, great. And then a couple other things. You got commissions, survey amendment here, and it just kind of adds it all up here together.
I think before we move on real quick, Paul,
Yeah.
it's important to note, because I get this question a lot when I'm working with a borrower. Maybe it's something they haven't discussed with their agent. As a buyer, you are not paying the real estate agent's commission. That is paid for by the seller. So I think that's really important for people to understand, because that money does not go into your cash to close. You're not paying. That's coming out of the seller's proceeds. They're paying both the agents involved.
I appreciate you sharing that, because a lot of people still don't know that.
Correct.
You get free services, negotiations, working through the process, make it smooth, great referrals like lenders like yourself. So, hey, it's win-win. And it astounds me, but some people think, oh, yeah, I'm going to save money, this and that. It's like, you end up losing money. So you buy it too high or don't know how to work through the process. So that's, I appreciate that. Thank you so much, Mike. So going through the commissions, and then looks like everything kind of works out here, and then you've got down payments, some other closing costs, and then just kind of all works together to that final number of, hey, this is the check you write it for, and there you go.
Yeah, this last page, it's really one of the best ones. It's the most clear, I find, because it's listing all the debits and all the credits.
Okay.
Right? So we total up everything that's due from all these first 2 pages are all the little line by line items.
Mm-hmm.
I like the 3rd page because it says, okay, when we add all those up, here's the purchase price of the property, here's the closing costs that we went through in these first 2 pages, and then here's the money that is being credited to you either from the seller or whatever somewhere else in the transaction. So they've already got their earnest money of 1% of the purchase price, which is pretty standard. They've got their loan amount. That's a credit to them from the lender. They have a seller credit in this instance. So the seller gave them some money probably to remedy something with the property that they found during inspections. And there's the adjustment for the seller paid title policy that you mentioned earlier.
That's the adjustment thing.
It is, yeah.
Sneak it in there.
Yep.
Okay, awesome.
Yeah.
Yeah, I'll go through, check some of the fees, kind of go through the main ones that I know, and then look at this one. This is where it all comes to, where rubber meets the road.
And you'll notice that nowhere on here does it outline what the down payment is, because it's kind of like inferred, right? Like we have this purchase price and we have this loan amount, and then we apply all the debits and credits, and then the cash to close. That down payment is in that bottom line number there. But there's not like a specific line item for down payment. It's just part of that money that's due. I've had instances where, all of the prepaid items and closing costs were paid for by the seller. So all the borrower brought was their down payment. That's how the math worked out. If you look at the difference between the loan amount and the purchase price, that number was the same. So it doesn't always happen, but it can.
Cool. Okay. Well, this is awesome, Mike. Thank you so much for sharing this. Hey team, thanks for sticking around. Episode 2 of Good Things Come to Those Who Real Estate. The last portion of the audio got cut off, so I had to cut that podcast off short. But if you're interested in getting a loan or have some questions about conventional loan closing costs, please reach out to Mike Boucher. His information is below. His phone number is there. Feel free to call or text him with any of your questions. And thank you guys for sticking around. Really appreciate it. Also, if you're looking to make a move, check out the link below in the notes about the home buying and selling kits that we created to help you get a better handle of the home buying and selling process. It's a confusing time, and just getting a little better understanding of what's going on and what you need to do is helpful to help make your next move a little bit more smooth. So that's episode number 2 of The Good Things Come to Those Who Real Estate. Thank you so much. We'll see you next time.